Hello, my name is Jim Smith from Catapult Research. Today I want to show you a relative comparison of NYMEX crude versus the S&P. So you can see the blue line here is the S&P, the green line is WTI, NYMEX crude. You can see here back in 2010 all the way to 2014, the two tracked each other pretty closely. And then suddenly halfway through the year in 2014, oil fell out of bed. You know, of course, OPEC discipline was part of the problem, but also the huge surge in supply from the frackers in the U.S., Permian Basin, etc. So you had a supply shock and too much oil on the market, it went down. This actually helped the S&P, I believe, more than people realize. Everyone gives credit to the tax cuts, which of course is true. The tax cuts helped the stock market. But I also believe that people are not really thinking about it. They've had cheap oil for a while, and even though it's come up here lately, it's still nowhere near what it was. So if we look at this move up in the S&P and we think about it logically, what happens if oil actually goes up again? And why should it go up? I mean, for some people, there is no such thing as a cycle. But based on Gann, we believe in cycles. And I do have Gann charts to show you if you're interested. You can send me an email. I'll send you the report. But there is a chart that proves, to my thinking anyway, that this was a secular low back in February 2016. We also have another cycle that indicated a low in December of 2018. So you have a low and a higher low. I don't think you're going to new lows here. I think even if we sell off, we probably will sell off in the next few weeks, but I don't expect new lows. So with that in mind, keep in mind that the long downtrend is over. We have a secular low. We have a higher low. We'll probably come off, but the next dip may be a buying opportunity. And we do have Gann levels that'll confirm the start of a next leg up, which is why you want to see that report. But here's the thing. If you're the Fed and you see that the S&P has been supported by cheap oil prices as well as the tax cuts, which are starting to wear off, the combination of both of those things going away is going to be problematic. What does the Fed do if oil actually starts to move up in a big way? That's a real question. Do they just ignore it? And, you know, typically they'll say that commodities are volatile, so we can safely food and energy, we can just ignore the volatility of these markets. Well, that's probably what they'll do, but if they do that, the dollar will sell off strongly. And, you know, because traders are not going to ignore it. They'll whack the dollar, and that will cause oil to go up even faster. Alternatively, if the Fed should decide to raise rates, of course, you know what that's going to do to the S&P. As soon as they raise rates, the S&P will fall off a cliff. So I'm saying either way, you got a real problem, because higher oil prices by themselves are going to be a problem for the S&P. And if the Fed raises rates, that's going to be a problem for the S&P. So it's not going to happen today, tomorrow, probably not next week, but, you know, at some point, you will see oil, after it dips in this near-term dip, it'll go back up again. That's when things get interesting. That's what I'm looking forward to, seeing how the Fed handles that. So it's just some food for thought. I'm not advising you to buy or sell oil or the S&P. I'm just telling you this is an interesting chart. You want to keep an eye on that relationship. And let's see what happens when oil really starts to go up.